So if you're self-employed, you run your own business, you own your own business, you're a freelancer, you're 1099. Basically, if you're not W-2, getting a mortgage can literally feel 10 times harder. I've experienced it myself. It's ridiculous that banks only give you credit for your taxable income, not your gross income. But what if I told you that there was a perfectly legitimate way to get approved for a mortgage using your true income, not just what's shown after all the write-offs on your tax returns? My name is Justin Lopatin. I've been a mortgage lender for over 20 years, and we've helped thousands of entrepreneurs and self-employed buyers purchase or refinance homes after banks, retail banks, have told them no. So let's get into it. A lot of people have left the corporate world, become entrepreneurs, or they're running successful businesses, and they're having a lot of challenges getting mortgages. The main reason is because the traditional retail banks solely focus on your taxable income, what you pay taxes on, not what you gross, but what you net, because you only pay taxes on what you net. So if your business generates $1,000 of gross revenue, but you write off $900,000 for expenses and insurance and payroll and, write-offs and depreciation on the assets, you're left with $100,000 of taxable income. Now, you made $1 million, but you only pay taxes on $100K. So that's what most banks are going to give you credit for. Probably won't work if you're looking to buy a home that aligns with your $1 million income. Welcome to the bank statement loan. This is the perfect solution for self-employed individuals and entrepreneurs that run a business, write off their income, still make enough money to qualify for the mortgage that they want. And these loan programs have completely changed the industry and the options for people like yourself. So how do bank statement loans actually work? So here's what we do. We typically look at either the last 12 or the last 24 months of your personal and or your business bank statements. We take an average of the monthly revenue you generate. We subtract any expenses. So for example, let's say your business brings in on average $20,000 a month. And on average, you have about $5,000 a month of expenses, not write-offs, but expenses that we can clearly see or verify through your accountant. So 20 gross, $5,000 in expenses. That leaves you with about $15,000 of income that we will give you credit for. Now, when you go and do your taxes, you're going to write off a lot of that income because you're not just writing off expenses. You're writing off travel and meals and insurance and depreciation and equipment and all these different things you can write off, right? So when it comes time to do your taxes, you're probably not showing 15 grand a month. You're probably showing 5. But the bank statement loan allows us to use the snapshot we want to take within 12 or 24 months, average out the income, remove the expenses, and give you credit for the real income your business is generating. And the beauty of this is it helps people qualify for the home and the mortgage they want based on the true income they're earning without waiting for you to file your taxes or without looking at last year's tax returns. Generally speaking, we want to see credit scores over 660 and down payment minimums are at 10%, but the better rates live in that 20% range. So if you can put 20% down on a bank statement loan, you're going to get a pretty competitive rate, not too far out from where the market is for those getting full doc, full income loans like the traditional banks offer on Wall Street. And sometimes people kind of question the rate, like, why is the rate higher? And, if the market rate's 6%, why am I paying 6.5%? And it's like, look, you just wrote off $500,000 of income that you don't have to pay taxes on. You can pay another $100 a month on your mortgage, get the loan you want after the bank said no, keep doing all your write-offs, and you're good. There's always going to be a little bit of a trade-off, but 1/4 to 0.5% higher interest rate for you to keep all your write-offs is a pretty fair trade-off. Would you agree? In my industry, the mortgage industry, we call these non-QM loans, which means non-qualifying mortgage. Now, that phrase can be misunderstood. A QM loan, a qualified mortgage, means it's backed by Fannie Mae and Freddie Mac, right? Meaning they can verify your income, we look at your tax returns, etc. A non-QM loan is a loan that's not guaranteed by Fannie or Freddie, and it's basically more of a portfolio loan, right? So my company offers them. There's a handful of companies that offer them. So some lenders can do, loans based off bank statements. Some lenders can do loans based off assets. We have different loan programs based off cash flow, where we look at the property if it cash flows instead of you and your income. Those are all non-QM mortgages because Fannie Freddie doesn't support them or back them, but that doesn't mean they're not viable options for you to buy a home or for you to qualify for a refinance if you already own a home. And according to a recent poll from Housing Wire, which is a national industry publication, these non-QM loans make up over 10% of all loans given and mortgages given throughout the country. So they're very prevalent. 1 out of 10 people is taking a non-QM loan because they don't fit into the big bank's retail box, right? These loans exist to give real buyers like you that truly qualify a shot at getting a great mortgage. You can use these loans for primary homes, for secondary homes, and even for investment properties that you're trying to cash flow. At Origin Point specifically, which is the company I work with, we have over 30 different non-QM strategies to help unique situations get solved, to help buyers get through their process. So here's another example. I recently helped a business owner who owns a marketing agency, okay? On paper, his taxable income was literally just under $100K. But when we looked at the last 12 months of his bank statements, it brought him up to about $300K a year because he was netting about $25K a month from gross deposits minus any expenses. It's about 300 grand. Using that bank statement criteria, we got him pre-approved for a $1.2 million purchase after his retail bank and his business bank said no. The guy was thrilled. The rate was great. He decided to do an interest-only loan, which is another unique strategy. So that way, some months he can make the minimum payment of just interest. Other months, when he has a good quarter, he can chunk down at the balance and just control, like a credit card, what his balance is and what his payment is. In other words, the more he makes his payment, right, the more he pays down the balance, the lower his mortgage payment is. And he loves that flexibility. He was like shocked that we could do this. So what do you need to know before applying? The initial step is just a simple pre-approval questionnaire. We gather some basic information, name, date of birth, address, right? And then really what we do is we take a look at the last 12 months of your bank statements. Ideally, we want to see consistent deposits at least every month or every other month. We want to see relatively strong credit, ideally over 660, but the best interest rates live when your credit's over 700. And oftentimes we need some type of CPA letter or email from your accounting team just confirming that your business is in good standing and maybe verifying any questions that we may have when we look through the bank statements. My team and I will analyze them. We put them through an analysis worksheet to help us understand what the monthly deposits are, what the recurring expenses are, so we can net your expense ratio. And literally within 24 hours, we can know exactly what you qualify for, what that correlates to from a price standpoint. So that way, when you're back with your realtor, you're aligned. You know what price range you should be looking at. You know that you qualify. The monthly payments are in your budget, and you can find a property, negotiate with confidence, and close the deal. Now, as I mentioned, most retail banks don't do this. Most mortgage lenders don't do this. And the ones that do, a lot of times they don't do them a lot. They don't know how to do them well. And there's some mistakes. We've been doing these for over a decade. We do them well. We do them every single month. And we can help you get through that daunting process when other banks say no. Now, if you're planning to buy a home in the next 6 to 12 months and you want a little bit of advice for how to make this process more smooth, here are a couple extra tips. Number one, separate your personal and your business financing. In the first year or two, sometimes entrepreneurs just keep everything in one bank account. If you haven't done it yet, get a separate bank account, one for your business with all your business activity, one for your personal stuff, and try to keep them separate. Next, try to avoid Venmo or Zelle. Get some type of payment processing element to your business so there's a way for us as lenders to verify what's coming in and where it came from. When there's Venmo, Zelle, and cash, it makes it a little more cloudy. It's hard to determine correctly what we're looking for. And lastly, it's okay to talk to a lender and your accountant before tax season, because if you plan on filing very aggressively, you should consider a bank statement loan. Some people are self-employed, they show enough income, they pay their fair share of taxes, and they totally qualify based off their tax returns. Most people don't. Be prepared, think it through, have some conversations, and anticipate, right? Instead of just being surprised and being caught off guard. If you're ready to have a conversation or you want to see how much you qualify for, click the link below. Let's schedule a 15-minute call, and I'll help you map out a strategy. I'll help you get aligned on your numbers. That way, when you see a home you love, you can confidently make an offer and not worried about getting denied by some random big bank who has no idea how to truly look at the income of a self-employed entrepreneur.